Always around the end of the year, everyone starts thinking about ways to lower tax liability. Why not get started with that process now, early in the year? It's a bit early, but let's go ahead and get right to it. I'm going to assume we're talking down the road. Kenner French, vastsolutionsgroup.com. We do tax, finance, and artificial intelligence for entrepreneurs, anything to help entrepreneurs. Of course, the IRS is not likely to cut you a check for any money that they owe you for the heck of it. Although in the right circumstances, by the way, that might happen. But you'll realize the cash when you pay less in taxes. Here are 5 powerful business deduction strategies that you can easily understand and implement before the end of the year. We're pretending we're around December. Number 1, prepay expenses using the IRS safe harbor. You just have to thank the IRS for its tax deduction safe harbor. IRS regulations contain a safe harbor rule that allows cash basis taxpayers to prepay and deduct qualifying expenses up to 12 months in advance without challenge, adjustments, or changes by the IRS. Under this safe harbor, this year's prepayments cannot go into 2 years down the road. This makes sense because you can prepay only 12 months of qualifying expenses under the safe harbor rule, as it were. For a cash basis taxpayer, qualifying expenses include lease payments on business vehicles, rent payments on offices and machinery, and business and malpractice insurance premiums, as a matter of fact. Example, you pay $3,000 a month in rent and would like to prepay $36,000 and get a $36,000 deduction. So on the last business day this calendar year, you mail a rent check for $36,000 to cover all of next year's rent. Your landlord does not receive the payment in the mail until, let's just say, January of the next year. Now, what is the result? You deduct $36,000 from this calendar year, the year you paid the money. The landlord reports taxable income of $36,000 the next year because that's when they receive the payment. You get what you want, the deduction for this calendar year. The landlord gets what he wants, next year's entire rent in advance, eliminating any collection problems potentially, while keeping the rent taxable in the year he expects it to be taxable. Don't surprise your landlord if he's received, a $36,000 rent paid in advance this year. He would have to pay the taxes on the money in the specific year that he receives it, as you would guess. Stop billing customers. This is number 2, clients and patients. Here is one rock-solid, time-tested, easy strategy to reduce your taxable income for this year. Stop billing your customers, clients, and patients until after December 31st. Now, we're going to assume here that you or your corporation is on a cash basis and operates on a calendar year, by the way. Customers, clients, patients, insurance companies generally don't pay until billed. Not billing customers and patients is a time-tested tax planning strategy that business owners have used successfully for many, many years. Now, I'll give an example. Jim, a dentist, usually bills his patients and the insurance companies at the end of each week. However, in December, he sends no bills. Instead, he gathers up all the bills and mails them the first week of January. Presto, he just postponed paying taxes on his taxes for this year's income by moving that income down the road in the future. Number 3, buy office equipment. Use bonus depreciation now at 100% along the increased limits of Section 179 expenses. Buy your equipment or machinery and place it in service before December 31st and get a deduction for 100% of the cost in this year. Qualifying bonus depreciation and Section 179 purchases, by the way, include new and used personal property such as machinery, equipment, computers, desks, chairs, and furniture, etc. Number 4, use your credit cards. If you're a single member LLC or a sole proprietorship or sole prop filing Schedule C for your business, the day you charge a purchase to your business or credit card is the day you get the deduction on the expense. Therefore, as a Schedule C taxpayer, you should consider using your credit cards for last-minute purchases of, let's say, office supplies and other business necessities. If you operate your business as a corp or a corporation, and if the corporation has a credit card in the corporate name, the same rule applies. The date of the charge is the date of the deduction for the corporation. Does that make sense? But if you operate your business as a corporation and you are, well, specifically the personal owner of the credit card, the corporation must reimburse you if you want the corporation to realize the tax deduction, and that happens on the date of the reimbursement. Thus, submit your expense report and have your corporation make its reimbursement to you before midnight on December 31st. Number 5, don't assume you're taking too many deductions. If your business deductions exceeds your business income and you have a tax loss for the year, with a few modifications to the loss, tax law calls this a net operating loss, sometimes referred to as an NOL. If you are just starting your business, you could very possibly have an NOL. You could have a loss year even with an ongoing successful business, by the way, hopefully not. You used to be able to carry back your NOLs 2 years and get immediate tax refunds from the prior year. However, the Tax Cuts and Jobs Act eliminated this provision. Now you can carry your NOL forward and it can only offset up to 80% of your taxable income in any one specific future year. What does all this mean? Truly, you should never stop documenting your deductions, and you should always claim all your rightful deductions. I've spoken to too many business owners who, actually really new ones specifically, who don't claim all their deductions when deductions would propose a tax loss. Again, Kenner French with VastSolutionsGroup.com. Thanks for watching. Hopefully it was helpful in some way. I'm sure it was.